right, Matt Orton joining in, Chief Market Strategist at Raymond James Investment Management. We're also speaking this morning with Anurag Singh, Managing Partner at Ansid Capital. Very good morning to both of you. Matt, great to speak with you again. What do you make of the claim that a deal is done? Would you feel more comfort actually seeing the dotted I's and the crossed T's?
Hey, good morning, Tamana. Always great to join. And of course, we would all love to see what it is, but it seems like this is going to be more of a black box for a while. And while we're talking about the deal being done, I think really the deal in principle, or really the framework of the deal in principle, has been agreed to. And I think the nuance here is that while it seems like we're making progress, which I think we all have to agree is very encouraging, that we're continuing to see progress made with China and Trump talking about progress with other countries as well. The challenge is a lot of this progress is focused on non-trade barriers that were implemented after the Liberation Day tariffs that were put on. We're not actually addressing the tariff levels themselves. So I think that is a key nuance that we need to follow. I think one, it signals that tariffs are here to stay, but two, that the US is proactively trying to find deals. And I think all of the other comments about unilateral tariffs, it's all meant to push our trading partners to get deals done faster, because we are approaching that July 9th deadline with respect to that 90-day reprieve that was put on by Trump.
So, point well made, Matt. I'm just looking at the reaction in the equity markets in the US, and ordinarily one would assume that there would have been a larger cheer to what Donald Trump claims is a significant move forward. Anurag, the question then to you is that are markets sort of pricing in the fact that it's not going to move very dramatically in the near term? It's going to be a lot of back and forth on these things. And the focus really will shift to how inflation comes into the fore, because the latest print does not capture the impact of higher tariffs.
Okay. So, Alex, on inflation, I think if you look at the past 3 months, okay, the weighted inflation core CPI is 2.1. Okay, so that's as well behaved as it can be. If you look at last 12 months, because Jan and Feb are usually, there's a bit of a spike, that is also 2.1%, right? So that's on an aggregate. I understand core is about 2.4, 2.5. Okay, inflation is broadly out of the system. The tariff was an issue, but I think as Matt was making the point, sanity has prevailed. I think the sense is that the administration and the likes of Howard Lutnick and Peter Navarro have realized that no manufacturing is going to relocate to US. So it's better we take a 10-20% tariffs and just call it a day and call it a victory and move on. I think that's the bigger message. In terms of reflecting, yes, I understand. There were various mechanisms where the stock was, companies were able to store the stock, so it's not reflected in the tariffs. But I think now that it is all done and behind us, I think the impact of tariff on US goods will be limited. And I think even the administration has now realized this, that that's not a game that we can play and win. The patience on US consumers about inflation is very thin, and I think China can persist it better than US can. So I think that's the good news, and I have no doubt that inflation broadly will kind of stay contained. The worst of tariff is now absolutely behind us, Alex.
Okay, Anurag, the other question is, almost everybody, including Jeffrey Gundlach, talking about how the dollar may be 10% lower than what may happen. And Matt, the same question to you, right? I mean, do you reckon that we are looking at a period of the next 12 months of a dollar decline, and what would that mean for fund flows into emerging market assets? I mean, if Jeff Gundlach says that he's de-dollarizing his investments, you ought to sit up and take notice.
Yeah. No, so Neeraj, first of all, I think Jeffrey Gundlach has his style of, he is high on emerging markets, he's low on US. Everybody has a position, so we got to understand where everyone stands. Okay. By the way, before let me address the dollar and then I'll come to the last point. Look, the dollar, Neeraj, Japanese are selling and the Chinese are selling. If you look at the Chinese stockpile, they had about 1.2, 1.3 trillion, 2016, 2017. They've been selling ever since. They want to de-risk, they want to be not like in Russia's position. So I think as long as they keep selling, the yields will go up. But at every higher yield, the buyers will come in, and which will also contain the dollar. So, well, at 108, it was overheated, but 57-58% of the dollar actually comes from Europe, right? So as long as Europe stops looking that attractive, which should be the case now, I think dollar should regain strength as well. That's kind of my quick take. I'll of course wait for Matt to add more spice. But by the way, side of that, kudos to you guys on McDonald's. And, I saw that and it was pretty spicy and interesting. Another interesting point, let me add, Neeraj, McChicken in US today costs less than it costs in India. And I was really shocked and surprised. I just bought McChicken for my son a while back before coming to your show. $350, two McChickens, okay? $350, which is like 300 rupees, two McChickens. So of course, the second one you get $1. So even the one is at around 250 rupees, which is just about the same. I mean, there was a time when I moved from India, India was like 40% of US price. Today, you are equal to or more than US price.
Yeah.
Take that. So, it's another interesting development.
And you know what, by the way, just before I get to Matt, if you're looking at liquor in India, it's going to be even more expensive than what it is in the US, in Maharashtra for sure.
And oil and petrol, so those are a given.
Yeah, and those are a given. So, but Matt, you want to come in on this whole argument? And by the way, Anurag, thank you. Compliments accepted. And this morning we were talking about it. We were crowing about it a bit because it's really had an impact and it's a wide consumer story. So we are very, very proud, nuttily proud that we did that story. So thank you. Compliments well accepted. But Matt, Orton, to you. I mean, do you believe dollar downtick over the next 1 year? And is that therefore inflows for markets like India?
So I think there's scope for the dollar to weaken more broadly, but I think the worst is behind us. I think a lot of the more significant fund outflows and, say, recalibration happen after April 2nd. So I think a lot of the very significant selling of the dollar, which has been taking place for a while, but it really accelerated in April, I think the worst is behind us. There's still reason to believe that you could see marginal dollar weakness, and that's my base case. But I wouldn't expect it to be too significant, at least in the next 3 to 6 months or so. That being said, that dollar weakness, or at least not having significant gains on the dollar from where we are today, that is a tailwind for emerging markets. And it's a tailwind for broader international global diversification. And so the main message that I give to a lot of our clients is that while the US still looks very, very solid from a corporate earnings perspective, which is important, it's not a zero-sum game. Even marginal changes, a 1% or 2% allocation away from the US to a market like Europe or into emerging markets, the scale difference between the US and everything else is so significant that those very, very small changes can have a big impact. And if investors are confident that you're not going to see significant dollar strength, which I don't think is going to be the case, you can feel even better about allocating money overseas. And that's really picking up in conversations. Many, many more clients are willing to allocate dollars overseas. And we were in India last week, and because there's real tangibility to people being willing and open and actively putting dollars to work in other countries outside the US. So I think that is a very good and strong tailwind for emerging markets.